I know you're looking at potentially this cut in December, but give us some clues on what the heck 2025 is going to look like when policy can be vastly different that this Fed needs to recalibrate for.
Yeah, first of all, separate from anything related to policy changes coming from Donald Trump, we're probably going to end the year with a core PCE inflation rate of something like 2.8%. That's usually your best bet for what inflation is going to be going forward. Then you add to that some fiscal expansion, some tariffs. We don't know the magnitudes of those, but they both push in the same direction. You're adding even more to inflationary pressures. I think that's going to make it hard for the Fed to continue its process of rate cuts at anything like an every meeting pace next year, maybe every other meeting at best, with an exception. If the economy starts to weaken, they'll be there. But absent that, we have strong growth, we have high inflation, hard to keep cutting.
Hang on, Jason. So save for their cutting bias, should they even be cutting in December? Does that even make sense with the environment that you just laid out?
Yeah, interest rates will still be contractionary after one more cut. In some sense, the way the Fed operates is they always wait longer until they're really sure, and then they start a continuous process of change, and that's where they are now. I think it would be sort of too shocking to the system to pull that one back. It would almost also look a little bit political. But yeah, after December, they need to take a hard look at the data, and I don't think it's going to say, keep cutting.
If we can go to that environment where you have higher yields and a stronger dollar because of whatever the Trump policies are, but because they're not cutting every single meeting, that means you globally have tighter financial conditions and maybe force rate cuts elsewhere, which again feeds this feedback loop of stronger dollar, higher yields in the US. Jason, what is the likelihood of that type of global environment where you do get this sort of doom loop with rate differentials?
Look, in some ways, a weaker currency is useful to a lot of countries around the world, which are struggling with demand. The higher dollar, in a sense, is shifting demand, from the United States to those countries. So in some ways, that's going to help with the global equalization. But Europe is in just a very different place than us right now. They have really weak growth. We have really strong growth. That means monetary policy should be different in those two economies.